every stock market crash in the last 100 years recovered. All of them. Yet, when the markets crash, most investors, they freeze. And in this video, I'm going to show you how to execute the triple strike strategy during a crash so that you're already in the market and profit from a rebound while the rest of the world still panics. So let's get started. You see, most people think that when the market crashes, it's too dangerous to buy. It's better to wait until things settle down because, who knows? It could get worse, right? Or maybe you should sell everything before it gets worse. Here's the surprising reality. Crashes aren't threats. They're actually opportunities disguised as chaos. And here's why. If you look at a chart, you will see that there are some dips, right? You see them here. And how many times does the market recover after a dip? Here's the deal. 100% of the time. We already know the markets will recover. They've done it every single time in the past 100 years. So the question is not, should you buy? The real question is, when should you buy? So here's the kicker. I'm about to show you a strategy that you can use. And when you use this triple strike strategy and strategically deploy your capital at a 10%, 20%, and 30% drop, you remove the need to guess the bottom. And you lock in the strongest gains when the market is rebounding, as it always has. Because I understand, waiting feels safe, but actually it can cost you more than the crash itself. So using this triple strike strategy means that you finally have a clear, repeatable plan that turns fear into confidence and can shave off years of your path to financial freedom. But before we get started, and I'll show you exactly how this strategy works, let's talk about a stupid myth. And this myth is timing is everything. You see, Wall Street and talking heads and even some financial advisors constantly say that you have to buy at the perfect time. And if you don't, you'll lose. And you see, this myth is everywhere, where there's some YouTube gurus calling bottoms, and there might be some of your friends boasting about nailing the dip. And you see, this might create pressure and paralysis. But here's the truth. In reality, even professional investors, they fail to time the markets. You see, there are many studies that show that attempting to predict the exact market bottoms lead actually to worse performance than simply having a system that I'm going to show you today. A rule-based system like the triple strike strategy. Because keep this in mind, you're either entering too early or you're entering too late. So you might as well get used to it. And this is the good news for you. You don't need to be perfect, but you do need to be systematic. And in order to be systematic, you need a system. And that's exactly what this triple strike strategy does. Because it lets you deploy capital gradually at a 10%, 20%, and a 30% drop. So there's no more guesswork required. And it works not because it's clever, because it removes the emotional timing trap and it replaces it with a calm, repeatable execution. So before I show you exactly how this system works, let me show you some data. I went through this whole report full of data for you. And here's the scoop. In the past 50 years, the markets retraced 25 times more than 10%. And that's called a correction, right? Also, in the last 25 years, the market retraced more than 20% 6 times. So that's called a bear market. And in the last 25 years, 4 times the market retraced more than 30%. And that's what we call an extreme bear market. And if you're curious about these extreme bear markets, right? This is where here are the top 5. So 1980 to 1982, we had the recession. In 1987, we had the Black Monday crash. You might have heard about this. In 2000 to 2002, the dot-com bubble. In 2007 to 2009, the financial crisis. And then most recently in 2020, the COVID-19 crash. Anyhow, so let's make this a little more practical. So let's talk about the frequency of these corrections. So that these 10% corrections, they occur on average every 2 years. These 20% bear markets, they occur on average every 8.2 years. And these extreme bear markets, these 30+% corrections, they on average occur only every 12.3 years. So I've done a little bit more math, and I put it on the screen here really quick, where you don't only see the corrections, the bear market and the extreme bear market, but also the minimum recovery time, the maximum recovery time, and also the average recovery time. So how do you take advantage of this? Well, this is where the triple strike strategy comes into play. So here's how it works. Let's say the market drops 10%. Now, this is where most investors either panic and sell, or they freeze and do nothing, waiting for the perfect bottom. But here's what the data tells us, right? After a 10 to 20% drop, the market has historically recovered in just 87 days on average. That's barely 3 months, right? And drops of 20 to 30% typically rebound within about 452 days. And that's less than 5 quarters. And even in the worst case scenario, drops over 30%, the market still recovers in about 10 months on average. So why wait for the bottom that you might never see coming? Well, because as I said, you're either entering too early or too late. The real risk isn't buying too soon. The real risk is missing the rebound entirely. So that's where the triple strike strategy comes in. So instead of trying to find the perfect moment, you simply divide your available capital into 3 parts. Number 1, you deploy the first 50% after a 10% drop, because it happens most of the time. I've told you just 25 times in the last 50 years. So this on average every 2 years. And this is the first strike. Now, if the market keeps falling, you deploy another 25% of your capital after a 20% drop. Now, as you know, this has happened 6 times in the past 50 years, or every 8 years on average. So this year is now your second strike. And if the market keeps falling, you deploy the final 25% of your capital after a 30% drop, which has only happened 4 times in the past 50 years, or on average every 12 years. And that's the third strike. Now, this approach does 3 powerful things. Number 1, it eliminates the guesswork. Number 2, it removes emotion. And number 3, it ensures that you're always moving with the market's momentum and not against it. So this is not gambling. This is mathematical positioning. And the good news is it works whether the recovery takes 2 months or 2 years, because you're already positioned in the market when the rebound begins. So in a nutshell, the idea is that you're basically sleeping through the crash and wake up richer, right? So think about it this way. So the market drops 10%, or maybe even 20%, or 30%. And while all the headlines scream panic, you sleep like a baby, because you already deployed your capital strategically, mathematically, and unemotionally using this triple strike strategy. And you're not guessing. You're not refreshing your app every 5 minutes. You're not waiting for permission from CNBC or some advisor who profits off your fear. You are now following a system built exactly for this kind of storm. And that's when you realize, oh my gosh, crashes aren't threats. They're your edge. Remember the famous quote from Warren Buffett? He said, "Be fearful when others are greedy, and be greedy when others are fearful." And this is exactly what this triple strike strategy does. It gives you the edge, because you're finally positioned to profit while the whole world panics. No more second guessing, and no more missing rebounds, right? Just quiet, confident progress while others, they kind of freeze, right? And this is how you basically sleep through the crash and wake up richer. Okay, now that you know the principle, let's put it in action. So here are 3 quick win techniques that you can get started with this today. Number 1, you set your crash trigger levels. So start with the current all-time high of the S&P 500. And right now, as I'm recording it, it was a few months ago, 6,147. So a 10% drop means 5,532. A 20% drop means 4,918. And a 30% drop means 4,303. And this is where you can go now into your trading app, or you can use something like TradingView or Thinkorswim, and you can set alerts for those exact levels. That way, when fear floods the market, you're already calm, ready, and executing. Tip number 2. Write the crash ready script. So create a 1-page doc titled My Triple Strike Strategy Playbook, and include these 3 bullet points. Number 1, if the market drops 10%, I deploy 50% of my capital into, and then you have a prepared list. By the way, if you want to know what I like to do, there's another video at the end of it. You'll see it there. Anyhow, second bullet point, if the market drops 20%, I deploy the next 25%. If the market drops 30%, I deploy the final 25%. Now, at the top, here's what I suggest. As a reminder, paste this quote in bold. Be fearful when others are greedy, and be greedy when others are fearful. Warren Buffett. Now, print it out. Keep it visible. This is not a plan. This is your new mantra. All right, tip number 3. You know what? Do a historical test run. Take the 2020 COVID crash. Pull up a chart from the S&P from February 2020 to December 2020, right? You'll see the 10% drop, it hit in just a few days. The 20% drop, well, this is where we see the March 2020 had a bottom there. And then we had a full recovery by August 2020. And now you can simulate. What would have happened if you had deployed your capital as discussed at 10%, 20%, and 30% drops? And on the other hand, what if you had just waited. So as you can see, the triple strike strategy outperforms paralysis every time. So use this as proof when doubt creeps in. By the way, if you're wondering of when to take profits, well, you take half of your profits off the table once you reach a new all-time high. And the other half, you can keep using a trailing stop. And I'll explain this in another video. Now, it all sounds great, right? But what could possibly go wrong? So let me tell you 3 mistakes to avoid. Mistake number 1, waiting for the perfect time. Now, in this video, you have seen the data, right? You know how quickly markets can recover. The biggest trap is still hesitation. See, there might be a little voice that says, just wait a little bit longer. What if it drops further? Well, here's the truth. Waiting feels safe, but it's actually what costs you the most. Because the rebound always starts when the fear is still high. If you're waiting for calm, you're already too late. Mistake number 2, deploying all of your capital at once. Well, excitement is good, but don't confuse conviction with impatience. You see, it can happen that you see a 10% dip and think, oh, let's go all in. But that breaks the system because it ignores the 20 and 30% entry points that create your edge. See, this isn't YOLO investing. You only live once. This here is warfare. In warfare, at the end of the war, you still want to have ammunition in reserve. You don't want to have no ammunition and the war is still going on. So therefore, follow the rule. Deploy only 50%, then another 25, then another 25. Stay ready. So here's mistake number 3. And that is not preparing in advance. You see, the crash won't wait for you to feel ready. If you haven't written your cash script, if you haven't set your S&P 500 alert, if your capital isn't divided into the 3 parts already, here's what will happen. The crash happens and you'll freeze. You'll default to emotion, and emotion doesn't build wealth. It erases it. You see, discipline starts before the drop, not during it. So go ahead, build your checklist now, set your triggers now, decide who you'll be before the next chaos begins. Oh, and if you want to know what to do during normal market times, right, if there's no crash, I have another video for you. So let's hop over to that one right now, and I'll see you in the next video.